Welcome to Dr. Fred Markets. This is not financial advice. Every day, the world of finance, crypto, and artificial intelligence moves fast, really fast, and staying informed is the only way to stay ahead. That's exactly what we do here, together. Let's get into today's video.
You're getting paid less, so rich people can bet on hurricanes. Signal 1. Wall Street now trades the weather like a stock. CME's weather derivatives market has handled tens of billions in notional value with contracts on temperature, snowfall, even hurricanes. You don't see it on CNBC, but utilities, energy traders, and hedge funds already hedge heat waves the way airlines hedge jet fuel. Signal 2. At the same time, water is quietly becoming an asset class. The Nasdaq Veles California Water Index launched water futures. Global water demand grows around 1% per year, and utilities keep hiking bills faster than inflation. In the US, water prices are up roughly 60 to 70% over the last decade, outpacing wages and CPI. Signal 3. And while you're rage-scrolling Toy Story 5 opening weekend or World Cup stats, infrastructure funds and private equity are buying control of the pipes under your feet. Water utilities, treatment plants, desalination, irrigation tech. This isn't ESG kumbaya. It's rent collection on every shower you take. So here's the cliff. Billionaires hedge against the sky while you complain about Netflix going up $2. Put those three together and the message is brutal. Climate volatility is no longer a future risk. It's already a priced product, and you're either on the paying side of the invoice or the owning side of the cash flow. Weather isn't a conversation, it's a line item. Water isn't a human right on Wall Street, it's a yield. The big money doesn't donate to climate causes, it trades the chaos and invoices your utility bill. Let's unpack the mechanism in plain language. Weather derivatives started as risk management for businesses that live or die on temperature. Utilities, ski resorts, energy producers. Instead of praying for a mild winter, they buy or sell contracts tied to heating degree days and cooling degree days. If the season goes against them, the payout from the contract offsets the lost revenue. It's insurance, but tradable and leveraged. Now add water. As hotter weather increases demand and strains aging infrastructure, water utilities need capital. Where do they get it? They raise rates and invite investors. Enter water-focused ETFs, listed utilities, treatment tech, filtration, meters, leak detection, boring stuff, except the cash flows are locked to necessities, not vibes. You can cancel Hulu, you don't cancel drinking water. Here's the part no one tells you. You already own weather risk. You just own it in the worst form, unhedged. Your rent, your groceries, your electric bill, your insurance premium all adjust to heat waves, floods, and droughts. But your portfolio stays stuck in the same 5 mega-cap tech names, fully exposed to cost shocks on the physical side. You eat the volatility, they monetize it. So what do you do instead of whining about inflation on Twitter? You study where weather and water become cash flows, not headlines. Not chasing climate hype coins, not ESG brochures. Real businesses whose revenue goes up when the planet gets weird. One concrete fact you now know: the same kind of futures contracts used for oil and corn now exist for temperature and water price indices, and big players are already using them. That tells you climate risk is not if, it's already underwritten and tradable. Your move is not to YOLO into obscure futures. That's how you blow up. Your move is to front-run the slow people by owning equity and funds that sit on the right side of that trade. Water utilities with pricing power, diversified infrastructure funds with water exposure, and companies that sell the picks and shovels of water efficiency and climate adaptation. You don't need to time the next flood. You need to own the businesses that get a raise every time the utility commission signs off on higher rates. Here's your 3-point plan. No fluff.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
1. Audit your bills versus your portfolio. If water, power, and insurance eat more of your paycheck every year, but your investments don't earn from those same trends, you're donating to someone else's yield. 2. Research water and weather-exposed assets the way you stalk meme stocks. Look at global water ETFs, listed utilities, irrigation and leak detection companies, and infrastructure funds. You want boring tickers with monopoly footprints, not shiny climate marketing. 3. Size it like an adult. This is a diversification sleeve, not your personality. Start with 5 to 10% of your equity side over time, scaled in, and revisit annually as pricing, regulation, and climate patterns evolve. Verdict: stop playing victim of the weather and start owning the invoice. This is not financial advice, but it is the truth. Every heat wave now prints money for someone. Decide if you're always the customer or sometimes the shareholder. And if you're thinking, Fred, isn't it kind of dark to profit from climate stress? Welcome to capitalism, my friend. Your discomfort doesn't stop the cash flows. It just decides whether you participate in them. Opting out on moral grounds while still paying the higher bills is not ethics. It's just expensive. Now, a reality check. This is a slow burn thesis, not a lottery ticket. You will not wake up next Tuesday and retire off a water utility. These are compounding stories, regulated returns, inflation-linked pricing, and political risk baked in. That's exactly why institutions love them and retail ignores them. So what do you actually do this week? Pull up your portfolio and ask one simple question. If the next 10 summers look like the last 2, who in my holdings gets structurally stronger and who quietly bleeds? Your crypto doesn't care if the Rhine dries up. Your favorite SaaS name doesn't automatically earn more because half of Texas is on rolling brownouts. But transmission operators might. Grid modernization funds might. Companies that finance and insure resilience infrastructure might. Then move one step further. Map your life to your capital. Where do you live? What utilities serve you? What infrastructure is being upgraded around you? Often the tickers benefiting from your higher bills are publicly listed, boring, and under-discussed. You don't need a hedge fund data feed to see the backhoe outside your apartment digging trenches for new pipes. 2 filters I want you to use when you look at these names. First, hard to replace. If a mayor can't get re-elected without that service functioning, that's bargaining power. Second, paid in real terms. Regulated returns, inflation pass-through, long-term contracts indexed to CPI. These are what protect you when your grocery bill doubles. And yes, there are real risks. Regulation can cap profits, populist politics can hit allowed returns, mismanaged projects can blow up budgets. That's why this is a sleeve, not the whole portfolio. You're not building a shrine to climate finance. You're adding a cash flow engine that tends to wake up exactly when the rest of your life gets more expensive. Most of you already have weather risk. Your rent, your food, your energy, your taxes, all tagged to climate volatility, whether you like it or not. The only question is whether you own anything on the other side of that equation. So next time the news runs a red heat map and your feed is full of outrage, I want you to pause and ask, where is the invoice for this, and do I own the company sending it? If the answer is always no, that is a choice, not a fate. Stay rational, stay invested, and stop pretending the climate economy is optional. It's already here. The only thing missing is your equity line. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.